Welcome to Cash Flow Mapping, the best way for you to become familiar with what this software can do for both you and your clients is to start with the end in mind. As we move through this, I'm going to show you one of the pages that is included in the print report that you can give to a client after you and your client have input all the data. Everything in this system converts all the dollars that we're going to talk about, no matter what category it's in, into a monthly number. That's important. The reason for that is most people get confused by the frequency of their pay being different from one spouse to the other, or one job to the other, or when bills are due weekly, monthly, quarterly, or annually. So to make it easy and consistent, we convert everything to a monthly number. We start with calculating the client's monthly net income. Our income input page allows you to work right from the client's financial documents, whether it be pay stubs, tax returns, or both, and get an accurate number as to how much monthly income they are actually earning. Once we do that, then we're going to work on where the client is saving money. We want to separate the conversation from short-term savings and long-term savings. Many clients will tell you that they are saving, but what they are actually doing is saving to spend on an emergency, a house down payment, a vacation, or something like that. We want to be clear that the intention of long-term savings is to eventually replace their paycheck. What's nice about this data input page is you have your typical account types, like 401k or simple IRA, which were populated from the pay stub when calculating the net income. In addition, this page acts as a fact finder, telling you if they have a diversified tax strategy or not. Whatever your philosophy is, this data input page will tell you what percentage of their income they are saving and where they are saving it. But for now, we just see the total amount. Third, we solve for a client's fixed expenses. In a minute, you will see that the system separates fixed and variable expenses. We do not refer to them as mandatory and discretionary expenses. So, what's a fixed expense? A fixed expense is predictable, both in timing and amount. These are easy for clients to figure out, things like their mortgage, car payments, etc. Variable expenses simply are not as predictable in time or amount, but are priorities. Items like groceries or dining out, for example. Fixed expenses are decisions that have already been made. Many of them may be contractual or legal obligations. Not all of them are due monthly, like property taxes, for example. But what we want to do, just like we did with net income, is take all those fixed expenses and convert them into a monthly number. In this example, the client needs to transfer approximately $9,000 per month into a separate bank account and pay those fixed expenses from there. The first thing that this does is increase the ability for clients to communicate with their families. Because if there are several bills within this $9,000 that are actually paid annually or semi-annually, then there's buildup of cash in this account. It's not up for grabs because it's already spoken for. This money is not available for other areas in the plan or consumer consumption. The reality is some bills just have not come due yet. Ultimately, what we're trying to do is solve for variable spending. Variable spending is the area where decisions are being made on a day-to-day basis, and the easiest place for the plan to fall apart if we're not careful. We started with, what's your true monthly net income? How much are you saving to replace your income in the future? And how much do you need each month to cover your fixed expenses? Here's what's left over for variable spending available. Now, we are going to empower the client to take it from here. So if I isolate the variable spending, there's 3 categories that the system will produce for you. There's the Save to Spend category. These are larger expenses that your client should save for, such as a family vacation or a remodeling job, or even building up a contingency fund to smooth out the variable spending over time. We take that Save to Spend number and convert it to a monthly savings account. This is important. I know that seems so basic, but separating the Save to Spend from the long-term savings is incredibly important. Remember, we want to empower your client by giving them clarity. After saving to consume, we want to figure out how much is needed for somewhat predictable items like groceries and gasoline or going out to eat. These expenses are not consistent every day, every week, or every month, but most clients have an idea on what they spend in these areas. Maybe buying a latte at Starbucks every day is a non-negotiable, or going to concerts, etc. Allocated spending gives them a placeholder for items they have decided about in advance. but not in a contractual way like in fixed expenses. This allocated spending number is important because it allows us to solve what's left after those allocated items. So how much is available for unallocated spending? The answer is, in this case, about $4,100 a month. This is where the rubber meets the road. This is what makes your advice on how to manage cash flow so different than anything else they have heard. This is easy for the client to implement. You are creating favorable conditions for success, which makes you irreplaceable and referable. At this point, I will remind you that cash flow mapping is forward-looking. There are plenty of tools out there that you can help your clients track where they have already spent their money, but that's like looking in the rearview mirror. We are all familiar with the tools that import transactions from your bank accounts and credit cards and attempt to categorize them correctly. The problem is that these systems commingle fixed and variable expense, and they are often categorized incorrectly, which means the client must stay on top of each transaction, which leads to frustration and eventually failure. What we suggest is that you help your clients tell their money where to go, instead of asking them where it went. So far, you have laid out a system that separates their long-term savings from save to spend. You have also recommended a separate checking account for just the fixed expenses, and now you are helping them manage their variable spending. The unallocated spending should be treated like an allowance. In this paperless society, a cash allowance isn't practical, but a separate checking account with a debit card or dedicated credit card for the unallocated spending is very practical. By dedicating one account for the unallocated spending, your client doesn't need to know where every dollar is going. They just need to know how much is available to spend. This approach promotes communication amongst family members. It avoids mindless impulse spending, and it supports the idea of delayed gratification and satisfaction. If they want to track their spending habits of the unallocated funds, then we encourage them to do so, but it's not necessary in order to succeed. Let's take a minute to talk about how you, as an advisor, can win by providing this valuable service. First, there are the intangibles. The cash flow mapping process creates a deeper, more trusting relationship with the clients. It also provides you with a documented process that supports your recommendations and shows your work. And of course, in this world of commoditization, you are separating yourself from the pack, making you irreplaceable and referable. Some of the tangible benefits are charging a fee for this service if you are properly licensed. If you sell insurance products, cash flow mapping will help you identify the protection gaps in your client's plan, simply by finding out how much money they are spending on term and disability insurance. Permanent insurance is not considered a fixed expense. It is an option under long-term savings planted in the seed for a future conversation. If your focus is wealth management, the system will help you find money for dollar cost averaging, perhaps selling guaranteed income products to cover the fixed expenses. Regardless of your focus, there are both intangible and tangible benefits to helping your client with understanding their cash flow.